in progress. Good morning, everybody. Welcome to our year-end tax planning webinar. I know there's lots of opportunities, potential opportunities, and we have some great guidance this morning by our team at CohnReznick, our corporate partner for CohnReznick for many, many years. I know some of the local folks and national team are on here, so you are on with the experts. So it's going to be a jam-packed hour and a half or so of some great context. Any questions you may have, we'll stop, periodically throughout the webinar and pick any questions, or if there are questions you prefer to type in the chat, please do that, but we will get all of your questions addressed. We'll be recording this, so we'll be sending this out to everybody as well. So don't feel like you've got to write every single thing down. You'll have the recording as well. So before we begin, I would like to have our panelists share a little bit about themselves, who they are, their backgrounds. I'm going to start first. I always like to start with ladies first, but I'm going to start first with Terry Kay, who's on our board, who's our treasurer. So I'll let Terry kick it off. And Terry, if you want to just pass it along on the Hollywood Squares, and we'll get through to everybody before we begin.
Perfect. All right. So I am Terry Kay. I am the South Florida tax practice leader for CohnReznick. I'm also the treasurer for SFMA and have been involved with SFMA for, I think, about 13 years now. I've been practicing tax planning and compliance for 30 plus years. And our practice focuses on mostly entrepreneurs, business owners, their families, their entities, and making sure that we are helping our clients minimize exposure and minimize taxes over years and over jurisdictions. So awesome. With that, I will kick it off to Travis.
Thanks, Terry. Travis Butler. So I'm a partner in our national tax office, technically coded cost segregation and accounting methods. I'm based out of our Chicago office. I've been doing this for about 25 years. Being in the national tax office, I'm industry agnostic. I deal with a lot of issues, obviously, with the OB3 bill, as Terry has been, as well as I've been. We've been talking about it a lot. We've been pretty busy, and there are a lot of changes that we hopefully will get across to you guys today, and a lot of things to take advantage of.
Awesome.
I'll pass it over to Kyle.
Hey everyone, I'm Kyle Parrish. I'm a tax director out of our Sunrise office. I focus on tax planning and compliance for manufacturing and distribution companies, helping companies and their owners minimize taxes and achieve their goals. Happy to be here with everyone this morning to talk a little bit of taxes. Over to Rich.
Hi everyone, I'm Rich Calv. I'm a senior manager in our national, state, and local tax practice. I specialize in sales and use. I've been doing this for nearly 15 years in sales and use, and more years in tax as well, but specifically, sales and use now. And I'm out of our Boca office, but I live in Tampa, and I'm starting to get involved in the Bay Area manufacturers group as well.
Great.
So trying to, provide some support out there as well. And happy to talk sales tax with this group.
There you
Darren.
go. Good.
Hi, so I'm Taryn Goldstein. I am a director in our national salt practice as well. I sit down here I sit in Parkland, but I'm out of our Boca office. I handle all of our Florida offices. I have been practicing for 25 plus years in Big Four accounting, international law firms, and in-house, mostly helping companies optimize their state and local taxes, but also through M&A, due diligence, and credits and incentives. So I'm kind of a jack of all trades. I turn to my specialist like Rich to handle the sales and use tax after I get out of my swim lane. I like to focus on income franchise, but I do a little bit of everything.
Very good.
And I'll pat. That's all of us, right?
Yeah, I think we're good. All right. Well, we got the all-star lineup, as I mentioned. Thank you again for doing this for us, all of you at CohnReznick. For those that just joined us a couple minutes ago, we will be recording, or we have this recorded now. We will go ahead and send that out to everybody as well, so you will not miss any important information, because I know we're going to cover a lot of great stuff. We're going to kick it off first with bonus depreciation and some other things here. We're going to first hear a little bit from Kyle and Taryn. I'm going to go to Kyle first. So Kyle, there's been a lot of press, a lot of buzz, a lot of excitement about things happening with manufacturers, about not only deducting the cost of equipment, but also potentially a building, right? As they're expanding and doing some things. I guess the hope in all else was, can this spur some reigniting manufacturers to reinvest in automation and new equipment and other stuff. So, can you share a little bit about how the depreciation rules have changed on this, and then what companies might start thinking about maybe for the end here of 2025, but importantly going into 2026.
Absolutely. So this is one of the biggest tax opportunities manufacturers have seen in years.
Yeah.
If you are planning capital investments, 2025 and 2026 is a game changer. So here's what's happening. Bonus depreciation, which is the immediate write-off of new machinery and equipment, had been phasing down. It was 100% in 2022, then 80% in 2023, and 60% in 2024. That meant every year you were losing a little bit of that upfront benefit, and capital projects were becoming more expensive after tax. However, starting in 2025, that changes. For qualified property acquired and placed in service after January 19, 2025, we're back to 100% bonus depreciation. That means businesses can deduct the full cost of eligible machinery, tools, automation lines, and certain building improvements in the first year. Instead of recovering those costs over, say, 5, 7, or even 15 years, you get the deduction now. That's a massive cash flow advantage, reducing your tax bill and improving your payback period immediately. But here's where it gets even better. Bonus depreciation doesn't just apply to machinery and equipment. With the right planning, you can unlock similar benefits for your buildings through a strategy called cost segregation. Cost segregation is a study that breaks down your building into components, things like electrical systems, lighting, HVAC, flooring, and manufacturing infrastructure, and reclassifies them into shorter life assets. Why does that matter? Because those shorter life assets qualify for bonus depreciation. So instead of depreciating your building, say over 39 years, you might be able to write off 20 to 30% of that cost immediately. And that's huge. And the kicker is you can do this if you even already own a building. If you bought or built a facility years ago and never did a cost segregation study, you can still do one now and catch up deductions through a method called a 3115 adjustment with no amended returns required. So the bottom line is, if you're planning equipment purchases or facility upgrades, or if you already own a building, now is the time to talk to your CPA. A cost segregation study combined with 100% bonus depreciation could mean hundreds of thousands in tax savings and a much faster return on investment.
Yeah, Kyle, that's pretty amazing. How far can a company go back? How many years? Because that could be some pretty interesting things for some of our manufacturers and members.
So you can really go back as far as you want to do a change in accounting method on certain buildings. So if you have a building, say, that was placed in service years ago, you never did a cost segregation study, can still absolutely take a look and see if you can catch up deductions based on the depreciation laws that were in effect at that time. So maybe it wasn't 100%, but maybe you could still get 50%, as that was the rate for quite some time.
That's amazing. No, thank you for that. Travis, I see your hands up.
Yeah, I figured that's the best way to kind of chime in.
Yeah.
That's great. Please, for the panelists. Yep.
Yeah, that's a great point by Kyle. The one thing I would just want to point out, a guy being in the National Tax Office, I got to point out the traps for the unwary kind of a thing, right? One is be careful. The enactment of the bonus rate wasn't 1/1/2025. It was 1/19/25. We've gotten a lot of questions from our clients. Well, what about the additions that we placed in service from 1/1 to 1/19? Unfortunately, you would fall under the old bonus rules. That's number one. Number two is, just because you place an asset in service in 2025 doesn't mean you get 100% bonus. There are these existing regulations that are out there that talk about, written binding contract. And let's say that in Kyle's example, let's say you're building a facility, you started building it in 24, and then you place it in service in 25. you potentially might not get the 100% bonus because of these other regulations. So again, it's critical to have those conversations, as Kyle pointed out, because there are those, as you can imagine, the IRS always likes to give you the general rule and then give you all the exceptions to the general rule that we need to kind of help you with. So that was it.
Great. No, that's great. Those are great points. Thank you, Travis. Taryn, what about some state implications of?
I think Terry's got her hand up.
Oh,
Sorry, Matt.
sorry,
I
Terry.
think Terry's got her hand up too.
Oh, go ahead.
Yeah, and I did thank you, but we can certainly go to state. So the other thing is that new for this year is manufacturing buildings. If you have a new building and you are a manufacturing company, and again, all the dates align because those are very date specific, then the actual cost of the building can be deducted as immediately, again, under these bonus rules, to the extent that the building is used primarily for manufacturing and only with regard to the portion of the building that relates to the manufacturing. So if you've got administrative offices and sales offices, then you would basically bifurcate the cost of the building between the manufacturing piece and the non-manufacturing piece and be able to immediately write off the manufacturing piece, which is huge. And then you can still make use of cost segregation on the non-manufacturing piece to even enhance it further. So if, as an example, you are thinking about investing in a new building, or whether it's new construction or it is something that you're going to go out and buy something, you want to make sure that you know what these rules are so you can make best use of them from your own cash flow. And now, Taryn, state.
There you go. Thanks, Terry.
Thanks, Terry. So I think, Matt, where we were going to go with this is, how does states treat 179 and the changes that are going on? It depends, and you'll hear me say that throughout this webinar. It depends. It depends on the state. It depends on how they adopt the Internal Revenue Code. And then once they adopt it, how do they decouple from it? And that's pretty important here with bonus depreciation. So just stepping back to take the 10,000 foot view, when the states adopt the Internal Revenue Code, they can kind of do it three ways. It can be rolling conformity, meaning that they just adopt it as it comes on. So whatever the Internal Revenue Code does, the states adopt it. They can have a static conformity where it's as of a certain date. California had one that was several years ago. They just updated it. So you always have to look to see what date they actually adopt the Internal Revenue Code. And then other ones are selective, kind of like we are. Basically what that means is that we'll adopt it each year as of 1/1/25 or 1/1 of that year. Florida usually does that somewhere around June, the very end of legislative session. So when legislative session gets pushed, that usually gets pushed, but it almost always goes back to the first of the year. There's a couple interesting things that happen here, right? So as Travis pointed out, it was enacted 1/1/19. If we adopt as of 1/1/25, where do we stand? Right? So there's going to be some questions around that. The states won't catch up with that probably until next year. That's generally the way the states go. So what we'll probably be looking at this point is we will move forward as if the states have adopted the new rules and bonus depreciation. But when we get into the spring legislative season, we should be watching to see who decouples. Or do we at that point decouple from bonus depreciation? And that's when we'll be able to kind of retroactively look at what happened in 25 and how are the states going to treat these different changes. And the other thing, and Travis, I see your hand up, but just one thing before I lose that train of thought, when we were talking about cost segregations, one other thing to think about if you get into a cost segregation situation and you're going through a study like that, think about your state property taxes. That can also help you classify your different pieces of tangible personal property versus real property, and getting rid of ghost assets and things like that to bring your property taxes down. And so you can always appeal your property taxes if you've done a cost segregation study. And that's really important when you're thinking about that, because it's a double whammy, right? Two birds with one stone.
Great.
Go ahead, Travis.
Awesome. good advice there.
Yeah. I guess I just wanted to add to kind of just to drive this all home and level set in terms of what we're talking about, right? Is bonus depreciation, and that's you're meaning that you're deducting 100% of the cost on the federal return, and then depending on what Taryn said, you're going to have to add that deduction back on the state return.
Correct.
Bonus has been around forever. Like, so we kind of know what states are going to do with bonus. We kind of follow along. What's interesting, and Taryn will probably either shake her head or give me a thumbs up, is that the concept that Terry was talking about, the qualified production property, that's a brand new code section. Like, we didn't have it before the bill. And so we don't know what, a lot of states are going to do. And it's 168N is the actual citation. And so this year, probably more than anything, and I think Terry would agree, we've been doing this a long time. The sense of modeling out your what you're going to look like from a taxable income perspective is so critical this year, because you're going to hear a lot more things further on in this kind of conversation about things that are going to be happening that are going to drive down taxable income. And so the last thing I'll just talk about is that to try to minimize this kind of add back on the state return, the other fixed asset planning idea that we could do is what's called a TPR study, or a tangible property regulation analysis. And the reason that's important is because you analyze costs that you don't change the life on. You actually move it from a building cost, so things like roofing repairs, parking lot repairs, HVAC repairs. You move it from a 39-year life to a deduction, not depreciation. So what happens is you don't have to add that back on the state return. So you get the double benefit. You get the deducted on your federal return, but you also don't have an add back on the state return. So a lot of ideas, a lot of things to kind of minimize the state add back, but that's what I wanted to add. Thank you.
That's a great solution as well. Keeping in the theme of deductions, Travis, we're going to shift gears a little bit into research and development, because there's always been, not always, but over the course of years, there's been some variations and fluctuations. Can you bring us up to speed as to what's happening now and maybe moving forward in 26 on that?
Yeah, so this, we're talking, if you guys follow the provisions, this is 174. This was I think everybody on the CohnReznick side would appreciate this. This was not well received by our clients. And this was a situation was before 22. These are research and experiment or research and development type costs. You probably never heard of it before because companies just deducted them on their tax return. You might have heard about them in correlation with taking the R&D credit, but that was really it. But you didn't really have any sort of thing to think about on the federal return because you just deducted them. Well, as part of the Tax Cut and Jobs Act from 2017, there was a slow rollout of this, and that everybody thought that this would go away, but 22 happened. And what they did was they said, hey, if your costs qualify as 174 costs, you now are required to capitalize those costs and amortize them over 5 years if they were incurred domestically. We have a lot of clients that incur those types of costs in a foreign jurisdiction. Think about software companies and other types of companies that may be within the M&D space that are doing something from a technology perspective, and they're coding in a foreign jurisdiction. You had to capitalize those costs over a 15-year period. And so that obviously wasn't well received because you're having to change that. And some companies were incurring a lot of costs within the M&D world in terms of for a lot of companies, they're always doing R&D, trying to make their processes better, making their product better, making it stronger, faster, better. And so it was a welcomed relief as part of the act over the summer that we're going back to the pre-22 years, where starting in 25, you can deduct those costs. But that's the first benefit. The second benefit is, depending on the size of the company, and that's based on gross receipts, you have a couple of mechanisms that you're able to recover those unamortized balances that you've capitalized in 22, 23, and 24. And so what you're able to do is in 25, you're able to recover those costs in either a 1 year or a 2 year period. So think about that. Now, Kyle talked about all of these deductions you can get for fixed assets. Now you get not only your 25 R&D costs, your current year costs to deduct, but if you have unamortized costs, you get to deduct those as well. And you just need to defer it. So my whole concept of modeling, it really just starts to come into play here about all these deductions, because let's say you drive these deductions down and I think that Terry's going to talk about it a little bit later. Let's say you push a company into a loss. Well, if you push a company into a loss, there's other rules you got to be worried about, and Terry will talk about that later. But then there are elections we can make to kind of make sure that you're maximizing the current year impact, meaning we can elect to capitalize 174 in the current year. We can elect out of bonus for certain properties. And then I think with every provision, we have to figure out what the state impact. And I think that maybe is where we go next.
Yeah, that's a great segment. Right over to Taryn, one of our resident state experts here.
So one of the things to think about, going back to, does the state follow 174? Do we have the R&E expenses? It's always going to depend on the state. Here in Florida, yes, you do get the deductions. There's not an add back necessarily for the R&E expenses. However, one of the things to think about, to Travis's point with modeling, is don't just model the federal side. You need to model the state side too, because here in Florida, if you take the expenses versus taking the credit, so for the R&D credit, you can't get a Florida credit. You have to have a federal R&D credit in order to get a Florida R&D credit. Now, that being said, the credit's relatively small here. We have a $9 million cap for the entire state. We had legislation was proposed for a $40 million cap, right? But that got shot down. Hopefully next year we'll get a bigger cap. But I think the big takeaway is, to Travis's point, you need to model this stuff out, and in any state that you're in, whether you're doing your R&D here, abroad, or in another state, making sure that you're looking at how does the state handle that particular expense or that particular deduction, to make sure that what you're getting on the federal side isn't washing with what you get on the state side. And that's where we see a lot of companies forget to go down to that next level.
And real quick, before we go to Terry, also you have to think about, if you're a global organization, there's this 174 provision. There are interactions with some of the foreign provisions that are out there. So you got to really think, so it's not even federal and state, it's federal, state, and international, because 174 actually has a direct impact to things like GILTI, if you've heard of that, and BEAT and FIDI, all these other acronyms. So sorry, Terry, go ahead.
Well, and sorry, Terry, just before you, then you got to go down the state side on that too. Does the state follow GILTI, FIDI, everything? We trickle down. We always we see it, we see the IRC, and then we go, do we want to do that? Maybe, maybe not. And every state makes a different choice. So making sure that everything that you do at the federal level, international level, you look to the state level. Go ahead, Terry.
So I just wanted to add, and obviously as anybody's watching this, you can tell how excited we all are about tax law. Hopefully some of that enthusiasm trickles down to you guys. So what I wanted to mention is that before being required to capitalize the research and experimentation costs, which includes software development, right? Everybody was very interested in seeing if they qualified for an R&D credit, because tax credits are dollar for dollar against taxes due, whereas a deduction is based on whatever your tax rate is. So once these rules for Section 174 came into play in 2022, all of a sudden, a lot of companies were like, I don't have any R&D, and they sort of gave up on getting the tax credit because they couldn't, they didn't want to have to capitalize the costs. Well, now that the capitalization is gone, the credits are more important than ever again. And you don't even have to be a profitable company. If you're a new company and there are some thresholds, you can actually save on your payroll taxes for some of the R&D credits. So it's very important to know what's going on in your company, what your income levels are, and to make sure that you are maximizing all of these different opportunities so that you're saving as much money in taxes as you can. Taryn?
So just thinking that through and remembering that we have a lot of flow through entities here, right? So we have a lot of entities here that the entity itself doesn't pay the tax, and everything flows up to our individuals because we don't pay tax in Florida. However, you do pay tax in other states. So one of the things you always want to think about with these deductions versus credits, do they flow up to the individual? Will I get the benefit as an individual non-resident taxpayer in another state? Will I get a benefit for either that deduction or that credit against my taxes And how does that play against our infamous salt cap, which is higher now, but still not as high as it should be? So you want to make sure that you're thinking about your structure and how it plays into your structure. So again, going back to Travis's point, it needs to be modeled out for your company to see how does all of this impact your particular company, and where are the expenses or the deductions or credits best taken for your particular situation. It's not a one size fits all, especially in the States.
Great stuff. Before we move on to the next topic on qualified small business stock, there's been a lot of great information shared in within the last 20 minutes or so. Does anybody here, our manufacturers, those that are joining us, any questions from you all that you may have for anybody on anything that we've heard? All right. Well, if there are no questions, if there's anything that does come up and you would like to put in the chat, please remember to do put your questions in the chat and we'll get them answered. So Travis, we're going to go back to you on this qualified small business stock. We're going to talk about some other helpful provisions for small and medium-sized companies. And can you maybe expand a little bit on the qualified small business stock, how it works, what can manufacturers do to take advantage of it, what can they reduce, if anything?
Yeah, great question. This is I can't emphasize it enough. Like, this is truly like a rare gift in the Internal Revenue Code. If you've never heard of qualified small business stock, this provision has been around since the 90s. And basically, we're not going to be able to go over all the nuances, Matthew, but I'll kind of try to cover it at a high level. But there are corporate level requirements, there are shareholder level requirements. But number one, you have to be a C Corp. It doesn't mean you have to be a C Corp today. As Taryn mentioned, if you're a flow through, there are opportunities to switch to a C Corp. But let's say, again, I'm going to use Terry and I as an example. So let's say that Terry and I, we set up our C Corp. We issue stock, and let's say that we set it up after the July 4th enactment of the bill. And then we'll backdrop into the rules and kind of how it works. So let's say Terry and I were 50-50 owners in the stock, and we hold the stock for 5 years. And then we decide we want to get out, we want to sell the entity, sell the company, and we sell it for a total profit of $30 million. If we meet the requirements of Section 1202, which is the qualified small business stock, Terry can exclude, not defer, exclude the $15 million of gain from her tax return. I get to exclude $15 million of my gain from my tax return. So this was a provision that was set up in the 90s to really talk about and help small businesses and startup companies to kind of drive that business. That's how it was originally set up. To be honest with you, when the act was coming out, I actually thought they were getting rid of this as a revenue raiser. I thought the provision was going to go away. But what they did, they actually changed 3 things that make it even better. So again, if you meet the requirements, and one of the requirements is that you have to be a C Corp. The second requirement was, before the act, you couldn't have tax basis in assets of more than 50 million. Again, it couldn't, if you had a C Corp that's been in existence for 30 years, it could never go over that $50 million threshold. Well, what they did with the bill, they moved that $50 million threshold up to 75 million. I don't know about you, 75 million doesn't seem like a very small type of taxpayer to me. So that's one favorable change. Number 2 was, if you kind of read between my lines, I said that Terry and I held the stock for 5 years. This went under the radar because a lot of people didn't hold their business or turn their business around within. So if you, under the old law, if you said, hey, listen, I want to flip it in 3 years, you didn't get any gain exclusion. And so people were like, well, it doesn't really fit because I'm going to turn it before the 5-year requirement. That was the old rule, was at least you have to hold it for at least 5 years. Well, they made it even better. They said, hey, well, now post July 4th, if you hold it for at least 3 years, so in our example with Terry and I, we would be able to, let's say we sell it after 3 years, we get to exclude half of our gain, or 7.5 million. And then there's a 4-year, you get 75%, and then back up to the 5-year of 100%. So that, number 2, they made it even better, right? And then number 3, which again blows my, it's still, I'm telling you, it's a rare gift. The old law was a $10 million exclusion per non-corporate shareholder. So in my example, each of us got our, I said 15 million. The reason I did that was the old law was 10 million. Now they now made it 15 million per non-corporate shareholder. And so this is, again, but there's a lot of nuances too that we're not going to be able to cover. All I think for the group here is that if you haven't thought about 1202 and at least evaluated it or model it out to see if it makes sense, you should at least kind of have a conversation, hopefully with CohnReznick as your tax advisor or a tax advisor that you use, because it truly is an amazing kind of exclusion of income when that event happens on selling a company. And again, you don't have to be a C Corp today. You can be a flow through, and we can work with the company to kind of transition to a C Corp and what that means, and working with your attorneys on writing the articles of incorporation, all that sort of stuff. But it's just, there's all sorts of things that even makes this even better. Like my last thing, and I'll turn it back over to you, is that let's say that Terry and I have families, right? We could set up trusts, and that trust would on top of get its own exclusion. So Terry would get her exclusion, and then her trust would get their own exclusion because it's per non-corporate shareholder. And so that's what we would call stacking the benefit. So just a rare gift in our code section. I'm actually still to this day amazed that it's around, and that we don't see more companies thinking about it, and more companies really evaluating, setting this up, because what you have to do is in year one, you have to make sure that you meet all those requirements. We help with documentation so that when that event does happen and you exclude those big numbers from your tax return, you have this documentation that says that's the reason I'm excluding, because I qualified under section 1202. So with that, I'll turn it.
That's amazing, Travis. I wonder how many companies just don't even know about it or know the complexity of. So, Taryn, I've got to ask, anything you want to share on the state side?
This one's a little, it's a little tricky. It's the same thing. It depends on the state, but when it's an exclusions are nice because each state, there's different places within the federal return where the state starts their calculation. So if something is excluded from income altogether on the federal return, the states don't necessarily even see it or think to add it back. So again, it's still something you have to look at each state to determine. Absolutely. But the exclusions are always nice versus deductions or expenses.
And real quick, before it goes to Terry, I guess I'm going to ask a question of Taryn, if that's okay. So Taryn, have you seen, and I've heard this through the grapevine, like I've seen that we have certain states that do like a 2-year budget, right? Mm-hmm. Like what have we been seeing in terms of like the companies that are I'm sorry, not the companies, the states that are within their current budget, and now this bill comes out, are they going to amend their budget, or are they going to stick with the budget that they set before, or do we not know, before the July 4th bill?
Yeah, I think a lot of it we're really not going to know, right? Okay. Our legislatures aren't really in session for those purposes. I mean, down here in Florida, look, we're still they're trying. There's the property taxes, right? They're trying to. There's 8 different bills I think up there to eliminate our property taxes. So that would have to be counterbalanced in the budget if this was taken into account to see how it's going to work. I don't think. With most states, as I said, they lag usually at least a year behind things. I think we won't start to hear anything really about a lot of this until the spring, when a lot of legislatures go back into session and really start looking at their budgets, and we'll know more by July 1st for most of the states.
Yeah, and more on the qualified small business stock. The stock can't be stock you're buying from other shareholders. It has to be issued from the company. So you don't have to be one of the founders. You can be a later person that bought in, as long as the industry is the right industry allowed under the rules, and as long as the you're bought, but you have to buy in, make the contribution to capital, and be issued stock from the company. So that's a crucial piece, because it could be the right industry, the right financial metrics, the right the company was set up properly, but you're buying it from somebody else, you don't get it. So that's a critical piece to this.
Yeah, that's a great
Absolutely.
point too, is that if you're also the last thing, if you're an existing C Corp, and you already issued your stock, you would fall under the old rules, right? If you wanted to fall under the new rules, you would have to issue new stock, now, to, those non-corporate shareholders for them to qualify under those three big changes, right? That you had. So that's one of the things that we get lots of questions on.
Awesome. Great point. Travis, one last question for you because I know you have to depart soon.
Yep.
Qualified opportunity zone deferrals. Can you share the benefits, the pitfalls, burdens, how it might change some investment decisions?
Yeah. So, for those that I think obviously within this world, if you're not in this world, then what this was this was supposed to be a one-time kind of planning idea to invest money into certain areas of the country and bring capital investments to those areas of the country. It was supposed to be a one-time investment, and we really don't know yet. Really, truly, the metrics haven't told us if it's been a success or not. But what's interesting is that what they did with the bill is they actually permanently extended it. And so the reason that's important, and just a level set what would happen, what this is all about, is this is a gain deferral opportunity where people can invest their capital gains and invest those capital gains 100% into an opportunity zone fund. And if they do that, they get to defer that capital gain. They don't have to recognize it. And then within the opportunity zone world, there are a lot of provisions in terms of how that works and how long if you hold it for a certain amount of time, you get a step up in the basis. And then what happens if you hold it for, let's say, past the 10-year period, what happens there? What's interesting about this is that those capital gain deferrals are coming due on what we call the opportunity zone 1.0 is what I'm going to call it. They're coming due 12/31/26. And so everybody was starting to think about what's going to happen? Is this going away? Are we doing it again? And so with the OB3 Act, they permanently extended it. So what will happen is, which is good news, is that in July of next year, the governors of each state will identify their opportunity zones. And then those opportunity zones will be approved by the IRS and the Treasury. And then those new zones in the 2.0 will be designated as of 1/1/27. And so what will happen is it'll start a new clock where you could invest in those opportunity zones, defer these capital gains. Everything stayed about the same. If you're in this provision, one of the things they took away, which was unfavorable, was if you held it for 5 years, you got a 10% step up in basis. And then if you held it for another 2 years, you got another bump. They took that away, that little bit of bump away. But in compensating for that, they now designated this thing called the qualified rural opportunity zone, which is obviously just think about the word rural opportunity, and there's definitions behind that. But think about on the normal opportunity zone, you get a 10% step up. On this one, if you qualify, you get a 30% step up. The only downside is the reporting requirements are stringent. You got to make sure that you've documented and all that sort of stuff. You got to make sure that your plan on how you're investing in that opportunity, how you're using those funds and the capital to fund that investment, whether you're building a strip mall or you're building, apartment buildings or whatever you're going to build there. But it's definitely been something that at least here at CohnReznick, we've definitely seen our clients investing in these funds and being able to defer these gains. Like with anything, last thing I'll say with anything with relation to changes from the bill, we're expecting more guidance on stuff. We're expecting more guidance on bonus depreciation, the qualified production property, 174, and opportunity zones is in there too. As we were talking about, I think when everybody jumped on, the government is shut down right now. That does include the IRS. The IRS at the start of the year had about 100,000 employees. They laid off about 25,000, and right now there's around 20 to 25,000 people working. So that guidance is going to be long. And the reason I bring up the guidance is because if you think about the timing, there's a gap. So if you invested today, you would still have to recognize that deferred gain in 12/31/26. So is there going to be a lapse in investments until these new opportunity zones come into play, or can you invest today because it's after the act and fall into these zones that haven't been determined yet. So we got some questions that we need answers to, but it's definitely an opportunity if companies are looking for ways or looking for ideas to obviously defer capital gains and invest into. But again, you would invest in the fund, and then the fund would invest in the zone, if you will. And then we have specialists within CohnReznick that can speak to the details and the reporting requirements. I know enough to be dangerous, but there are obviously nuances to it that you want to make sure that you document in that year of investment.
Thank you, Travis. Taryn, anything on the state side?
So it's interesting with the opportunity zones because they are set by the states and then approved by the federal government. So this is kind of a joint effort here. Most of the states do follow the zones and the deferral, but there are a few that have limitations. States like Arkansas will limit it to only in-state opportunity zones. So if you are an Arkansas company and you invest in a Florida opportunity zone, they won't recognize the deferral. So it's only the in-state zone. Other states add actual extra benefits. You've got states like Ohio, West Virginia, even Wisconsin that have additional benefits on top of it to try to spur that investment in those zones. Florida hasn't done that yet. We're not real big on credits and incentives right now, and I know we'll touch on that a little bit later. But most of our incentives have gone by the wayside at this point. The other thing to watch out for are some limiting rules. It's not with respect to the deferral itself necessarily, but more requirements to become eligible for the deferral. So minimum wage requirements in Maryland. Certain states have specific entities that are eligible and others that aren't. So you just have to look at the rules again in each state to see if you get the same deferral at the state level that you'll get at the federal level. And always looking at that basis change. Generally, the states follow federal basis, but you've got some fun ones like California where technically you've got different basis for depreciation in California. Whether or not people do it right is a whole different story and discussion we could have another day for several hours. But there are certain states that do have basis changes, and you should be running an entire separate set of books just for their basis. So I'll put that out there as a flag. But
and just one last thing, because I again have been going around the country having this conversation. Probably the number one question I'm getting on opportunity: can I just roll my existing one into 2.0? Can I just roll it? And you can't. There has to be a line in the sand in terms of drawing and closing the loop on 1.0 and closing the loop there, so that then they can then value what 2.0 will look like. So. But again, expecting some transitional guidance at some point on how this is going to kind of transition with that little kind of gap period that we have between 1.0 and 2.0.
Thank you. Before we're going to get into some more state-specific stuff with Taryn and Rich here in just a minute or so, but I know we spoke a lot on some federal stuff. Does anybody have questions on anything that's been discussed, or does anyone want to put a question in the chat that we can answer? If you do, please go ahead and do so. So Taryn and Rich, kind of moving right along. So Taryn, we're going to stick with you for a minute or two. Speaking about the state side, how do they know how much to tax you? How do you mitigate some of the risks, some of the audit risks? If you could share a little bit on that.
Sure. So generally, states look at what we call an apportionment formula. Traditionally, this was a 3 to 4 factor formula. Property, payroll, sales. Sometimes double weighted sales. In Florida, we still have the 4 factor formula: property, payroll, double weighted sales. This was all based on brick and mortar stores. Manufacturing was one of the big industries actually that created the 4 factor formula. As the world has changed and e-commerce has come into being, many states have gone to single sales factor. Florida just hasn't. We can't tell you for sure why, but they don't like to change their rules, and they haven't changed them, and we don't see them changing them anytime soon. So it's a benefit and a burden, right? It can be helpful because if you've got high sales, the property factor can bring that apportionment ratio down. Essentially what it is your property payroll and sales within a state over your property payroll and sales everywhere and add it up. One of the big questions becomes, well, how do you know what sales go into a state? Property and payroll is pretty obvious, with the exception of remote workers, which we won't go down that path today. But if the property's in the state, it's in the state. There's not much of a way to pick up the dirt and move it somewhere else. So when we look at the sales, how do you know where that sale ends up? Generally speaking, if it's tangible personal property, it's wherever you ship it to. Drop shipping can create some complexities. If you drop ship for somebody, is it where your customer that told you to send it is located? So if you have a New York customer that said send it to my location in Massachusetts, is that a New York sale or a Massachusetts sale? You have to look at the rules for each of those. But the bigger thing, and it doesn't really apply that much in manufacturing, again, unless you're contract manufacturing. We kind of talked about this in our last seminar. Contract manufacturing is considered a service for purposes of apportionment in most states. And services are sourced differently. Services can be sourced one of two ways, generally. Cost of performance. Where did it cost you the most to perform that service? So if you're a manufacturer here and you're doing contract manufacturing for somebody in Georgia, your costs are probably here. The greater of your costs are probably here. So a cost of performance state would say, okay, that sale is a Florida sale. Or you could go under the market rules, which generally will say, where's your customer? Where do they get the benefit? So Georgia would, as a market state, would say, well, that same sale is a Georgia sale. Where Florida, who we have both rules I'll go into in a minute, but let's go with the cost of performance right now. Now you've sourced that sale two places, Florida and Georgia. And I know everybody's going, how can that be fair? That can't be fair. We're sovereigns. The states are each sovereign. It's the way it goes. If your apportionment's 100% and you're a multi-state manufacturer, you've done something wrong. You should never be 100% on the dollar, on the dot. Your apportionment should either be higher or lower. If it's higher, then you need to talk to us because we'll get it back down. You can do something better. If it's lower, that makes sense because you've got these different rules. For purposes of this group that's mostly in Florida, I assume all in Florida, but multi-state, if you are a contract manufacturer, you do have the option right now of taking a market position. So even though your cost of performance may be higher here because you're located here, your facilities are here, so all your costs are really going to be here for the most part, but your customers are somewhere else and they're paying for your services, Florida has the ability to say, okay, well, we have market sourcing on the books as well, and you can make that choice on your return. These two positions are actually in the Florida courts right now. There's several different cases going through the court system. They've been put on hold. We're waiting for them. They were supposed to start up again this fall to see. Originally, the Florida legislature said, cost of performance, that's it. We don't want market. You had to get it on a case-by-case basis. So you had to go for what we call a TAA, which is a binding agreement with the state. The state in the past few years has flipped and said, this is hurting us. We're losing our out-of-state sales. So we're going to start saying, okay, you have to apply market where we want you to. And companies have come back and said, no. I'm not based in Florida. I want cost of performance because that means I don't have to send any of my sourcing to Florida. This disagreement or flipping of positions has created an opportunity for us to be able to say, you can take either one. We can go back for refunds to get protective claims, but there is a risk if the state wins and it's cost of performance and you took market, you may have some past liabilities and exposure. Same thing, vice versa. But if the statute runs while you have it going on, if the statute runs, so if that year closes for you, then you got your benefit. So again, it goes back to Travis's point. I know he had to leave, but back to Travis's point, let's model it out. What's the best answer for you? What's your risk? And can you take this position to lower your Florida apportionment?
And
Thank you, Karen.
I'll just jump in. everything with state and local taxes is under their laws at the time. And
Yes.
until you file a tax return, the statute of limitations, meaning that they can come back for you for things that happened in the past, if you don't file a tax return, there is not a statute of limitations running, which is why there's an audit risk, that they may come back a few years later. How do they find you? Well, there's a lot of different ways. One of the ways is if a company that you do business with, that you buy product from or you sell product to, if they get audited in a state, they may have to turn over their list of suppliers or their list of customers. Now your company is on that list and you get a letter from the state saying, hi, we'd like you to tell us what you're doing in our state. And that opens a whole chain of events. What we find when we talk to companies, even manufacturing companies that say, I am only in Florida. I don't go anyplace else. I don't do anything else. I don't have employees anyplace else. Well, maybe you have independent contractors. Maybe you are shipping out of state. Maybe you are going to trade shows out of state and you're spending enough time in those other states for a trade show. Maybe you go and install your product that you ship to your customer. Maybe you go there and actually install it for them. So there are lots of ways to get tripped up with state rules. And usually you don't find that out until the state comes knocking on your door, or you go to sell your company and then you find out when due diligence is done, which I'm going to talk about a little bit later. But those are really when you get tripped up with this, and it's much better to deal with it up front. One of the benefits of dealing with it up front is that there are voluntary disclosures where you can go to a state proactively and say, Illinois, I never filed in your state, but I should have. Here is the information. Here are the back tax returns. And the states waive the penalties generally. So now you don't have to worry about them coming back. Different states go through cycles where they have amnesty for certain periods of time. And maybe you get lucky and you're going to deal with it when there's a period of amnesty, or you have like a little list of states you need to get to and you're waiting for their amnesty. Illinois is one that's going on right now. But this is something that as a business owner, it really is critical to at least be aware of the possibility that you may have state obligations someplace else. And income tax obligations are different than sales tax obligations. You may have one and not the other. So this area is complex. I like to call it brain surgery because, you can't, as a business owner, as the CFO, you can't be expected to know the rules in 51 states, 50 states and jurisdictions within. And that's why you really need, to partner with companies that can help you and advise you of what those rules are. So if it's okay, I know, Rich, you've been sitting here not saying anything yet. And I just wanted to find out, because I mentioned sales tax. What are the rules in Florida for sales tax that our manufacturers and distributors need to know about? And, just kind of walk us through those.
Yeah, so great question. And just want to real quick talk about the amnesty in Illinois. That one is coming up on November 17th. So if for any reason, income tax or sales tax, there is some potential exposure, back taxes owed, it has to be filed and paid by the 17th to participate in the program. And it does waive, like Terry said, interest and penalties. So.
Yeah, just I wanted to emphasize that, Rich, the difference between an amnesty and a VDA. A VDA cuts the look back period and waives the penalties generally, right? They can only look back about 4 years, 3 to 4 years. The amnesty is waiving penalties and interest, but for a specific period of time. So you may need to actually do the amnesty, which you have to pay the tax by the 17th, as Rich mentioned, and file the application. You may want to do that in conjunction with a VDA to cover the periods that it does not cover, because it only goes, Rich, you'll tell me when I'm wrong on this one, July 1st of 24?
Yeah, it goes June 30th, 2024 is the ending period.
Is the end of the period. So you still have another year plus of open taxes that you'd want to get the penalties waived, you can do that by virtue of doing a VDA along with the amnesty. Sorry, Rich. Back to you.
No, that's okay. Yeah, so I'll just kind of high level sales and use tax, how it applies in the state and talk about that. So sales tax is essentially in Florida, it's on all tangible property. Anything that's purchased, a widget, anything that's tangible is subject to sales tax in the state, as well as certain enumerated services in Florida. And I'll get into the manufacturing. There's certain carve outs for manufacturing equipment and everything. But just at a high level, tangible personal property subject to sales tax, certain enumerated services. For a manufacturer, those services, there's not a lot, but if there's installation of tangible personal property, those installation services are going to be taxable as long as the TPP does not become permanently affixed to real property and become either a fixture or real property. Those will be exempt from sales. That installation services will be taxed. Also, companies might not realize, but these are kind of like the one-offs. Pest control is also subject to sales tax. So the services. So Florida, I know in my house I get a lot of cockroaches and everything. But if you're doing pest control, that's going to be if you're purchasing pest control, that's subject to sales tax, as well as security services and cleaning services. So at your manufacturing facilities, offices, any of those types of services that you're purchasing from a third party, those are subject to sales tax. So use tax is when a company is not charged sales tax, but the item is subject to tax. So you purchase a piece of tangible personal property and your vendor does not charge you sales tax. You are responsible for self-assessing and remitting the tax to the taxing jurisdiction. So my example that I like to use is I used to live in Ohio. I could go over to Pennsylvania and buy clothing, which is tax-free, and then bring it back into Ohio. So even though I did not pay tax in Pennsylvania, when I bring it back to Ohio and use it in Ohio, it is now subject to sales tax in Ohio. Most states will not go after the individual because it's very difficult to audit this, but they do go after businesses. And the area that you would see it in the manufacturing space is when you're purchasing raw materials that you're using to make your product, right? So you purchase these raw materials, you provide a resale certificate to your vendor, and you do not have to pay sales tax. If you then use the product, if you consume the product personally in the business, so either you use it directly in the business and not part of what you're making, or you manufacture your widget and then you keep that widget and use it, maybe you give it out to your customers or give it out to your employees, you are responsible for paying the tax on the purchase of those raw materials because you're the end consumer, not the company that you're going to be, because you're not selling it to another company, right? So sales and use tax is always on the end consumer. It's different than a VAT tax, which is at each level of the process. In the United States, it's ultimately on the end consumer. And then just to get to the manufacturing equipment. So in Florida, they do offer an exemption on manufacturing equipment. There's two different ways you could qualify for this exemption. One is that the equipment has to be industrial equipment that's used in an eligible business, and it must be used at a fixed location. Okay, so at a fixed location, you can't be having anywhere. It has to be at a specific manufacturing facility. An eligible business is one that falls under the state's specific North American Industrial Classification Codes, or their NAICS codes, for a manufacturer, for manufacturing activities. And then the property, the industrial machinery and equipment property, must be one that has a depreciable life of 3 years, and it must be integral to the manufacturing process. So if you purchase any machinery equipment that meets those qualifications, you could purchase it tax-free from your vendor. So what you have to do is you have to issue an exemption certificate, letting them know that you will be using this property in the manufacturing process, and then they will not charge you sales tax on this equipment. If for any reason you purchase equipment and then you decide that you're not going to be using it in the manufacturing process, but you provided the exemption certificate, you have to self-assess use tax on that equipment and remit it back to the state. And then the other way is if you're another option is if you are purchasing machinery and equipment that will be used at either a new or expanded facility in the state. So you could also get an exemption from sales tax on that as well.
I had a question for you, Rich, but I saw Taryn's hands up, so we'll let her chime in here.
Terry was first.
Yeah,
Oh,
I just
Terry,
wanted to
sorry,
men-
yes.
Yeah, no worries. I just wanted to mention that as of October 1st, rent is no longer subject to sales
Yes.
tax, commercial rent. So any of our manufacturers that don't own their facility that they're renting from somebody else, you are no longer subject to sales tax on the rent, which is a great thing. We were one of the only states that did have that commercial rent tax. So it's good that that's
Yep.
gone now. So.
Absolutely.
And if you prepaid that rent, your landlord should be paying it back to you. So if you prepaid through the end of the year, then your landlord owes it back to you, or you can go to the state and get it back from the state. The landlord cannot get a refund from the state without proving that they've paid you that money's back. Which actually refunds was one of the reasons I raised my hand. Rich, on the manufacturing exemption, if you didn't have your exemption certificate and you paid sales tax on manufacturing equipment, can you go back for a refund?
You can, yes. Yes, so we do help our clients do that. So what services we offer is if you are a manufacturer and you did not pay the tax, we could come in, we could review your purchases, identify which ones you could use the exemption certificate on, and then go back to the state and request a refund for that sales tax. You'll go back to the statute of limitations, which is 3 years in Florida. So you can only go back to the statute of limitations. So you can't go back forever. So it'd be any of these items purchased within the last 3 years, which you paid sales tax on. You go back and request a refund from the state. Or the other option is you can reach out to the vendor and let them know that you have an exemption certificate and try to get the tax back from them. That is a little bit more challenging to request the tax back from the vendor, but that is an option, right? If you have a good relationship with the vendor and maybe it's not a lot of sales tax that you've paid, you can always reach out to them and find out if they're willing to refund that sales tax.
And one other question on use taxes. So if I'm a manufacturer of widgets and I have an inventory sitting in my warehouse being held for sale, if I pull some of that out to send as samples or to give away at trade shows, what happens with the taxes there?
Yeah, so that goes back to what was mentioned about earlier. If you're going to use it personally in the business at a trade show to give it out for free, if you provided a resale certificate when you initially purchased it from the vendor, which most likely would, then that item would be subject to use tax. So you should self-assess the tax on that amount and then remit it with your next tax return to the state.
On the amount the cost, not the cost that you paid for the materials, but the cost of whatever that widget is.
It would be the cost of what you paid for the
material.
material. No, it would be the cost of what you paid for the material, correct. Yes. Yeah, so if you paid $10 for the material, that's what you'd self-assess the use tax on.
Gotcha.
Rich, what about tariffs? Anything related to tariffs and subject to sales tax? That's it's a hot topic.
Yeah, no, that's a great question. So Florida has not released any specific guidance on tariffs. Okay, but what we want to look at with the tariffs is how does Florida define sales price? And before we even look at sales price, we need to understand like how the tariff works, right? So when an item is brought into the country, we need to look at who is the importer of record for the tariffs. Okay, so a manufacturer who's bringing in the item, if they are the importer of record, then we look at, okay, are they going to sell that item or are they going to consume that item? So if they are going to sell that item, then that's where the sales price comes into play. And Florida essentially says anything that goes into getting the product ready to sell is considered part of the sales price. Okay, so the cost that you're paying to purchase the item, the labor that goes into manufacturing this item, this all goes into that sales price, and that's subject to tax when you sell it. Okay, the tariff would also be included in your sales price if you're the seller and you're going to raise your prices to make up for the tariff, then that sales price with the tariff included is subject to sales tax to the purchaser. So the seller is not paying sales tax on that item that's being brought in. Okay. If the importer of record is the consumer of the item in which the tariff was applied to, Florida is silent on this, but based on reading of the code and how other states treat this, it appears that Florida would not subject that tariff to sales tax because it's not exactly the sales price. The importer's using it, so it would not be subject to sales tax for the importer as long as they're consuming the product that the tariff is on.
Okay. Well, now we heard a little bit earlier about incentives, and there might not be as many incentives still remaining in the state of Florida, but could you maybe explain a little bit about any tax credits in Florida or incentives in Florida that might be worth sharing with the group? I know there's been a lot of legislative changes over the last 5 years or so, but
yeah, I'll let Taryn handle most of it.
Okay.
The ones that I talked about was really around the manufacturing equipment, the industrial equipment, where you do get the exemption. There also is a incentive for data centers in Florida. However, they recently changed the law. And in order to be able to take advantage of this incentive, you have to have at the data center over 100 megawatts of electricity. And that is a pretty significant number. It used to be 15 and they raised it to 100. So most taxpayers in the state will not qualify. Most manufacturers will not qualify for that unless they're opening a significant data center in the state.
Yeah. To put it in perspective, a 100 megawatt facility is really the size of a typical Amazon AWS type facility.
Yep.
So
yeah, there was some other stuff out there earlier as well with FPL and stuff, but your power's got to be massive. Okay.
Yep.
All right.
And just to tag on to that, Matt, from an incentives perspective, we did used to have quite a robust toolbox that we could use to bring companies into the state and expand companies in the state. With the change in legislators, it's just not a priority for the government right now, the state government right now. The only one really left is the capital investment tax credit, which takes somewhere around $100 million and 100 jobs. It can get scaled down, so it's still worth looking at it as it's a credit against income tax. The thing to remember with it is it is a but-for test. But for the incentive, I would expand my business somewhere else. So everything has to be negotiated before you make any public announcements, before you start hiring any people, before you lease property, buy equipment, any of that type of thing. The good news is that the pot of money that the local EDCs or economic developers used to have to use to match the state incentives is still in most of their budgets, and they do use it for incentives. So kind of what's happened is the landscape has shifted from us having state level incentives to having local level incentives. So if you're growing, expanding, looking to add jobs, especially, talking to the local EDCs, which is I used to have an EDC, I used to have a credits and incentives practice in my previous life for one of the big four companies. Happy to talk through that, but talking to the local economic developers, the BDB, the Beacon Council, the Greater Fort Lauderdale Alliance, they all have different things in their toolbox to help with different grants and incentives, but they're just not state level anymore.
And even within those respective organizations, they do a great job. They all have
Yes.
different rules and things. So
That's
what applies that Beacon Council will do, the Alliance may not. So, it gets a little dicey. And
Yes,
if anyone has
it does.
questions on that, reach out to us. And obviously, CohnReznick has a good relationship with them. We can get you in touch. But largely, a lot of the incentives did go away.
Yeah. That's
You
right.
know, there's workforce training grants out there that we
Yeah.
do, but that's only limited to because the money runs out pretty fast. So,
Yeah.
yeah.
And that's gotten better. I mean, that used to be so
It
onerous
has.
that nobody even went after it, but it has gotten a lot better.
It's gotten a lot better.
You are able to actually get the benefit, but
Yeah.
most of it is just not where it used to be.
Exactly. Well, let's turn a little bit to some business losses and maybe some limitations, but I'm going to start with Terry first. So Terry, if the business does have a loss or some losses, how can they reduce their tax burden? And then Taryn, we'll hear from you on some states if they follow any of those same rules, but we'll start with Terry first.
Thank you. So first of all, if everybody's head is not spinning yet, as you should probably realize by now, everything in tax law is very specific. And what is applicable for somebody in a different situation or with a different tax profile or business is not necessarily applicable for what will work in your business. So it's crucial to understand what of these provisions apply to you or can apply to you. And as I like to say, if anybody has gone shopping and went to buy a t-shirt and it says one size fits all, it doesn't really fit all, and it certainly doesn't fit all well. And it's the same thing with tax rules. So before, what we were talking about is excluding income and bumping up your deductions so that you have better cash flow. But when you start thinking about you've done so much excluding and you've done so much on the deduction side, now you have losses. And sometimes you may have real economic losses. You've actually lost money. And other times it may be a paper loss because of depreciation. The depreciation rules that we were talking about before, you can finance the equipment and still immediately write off the whole cost, right? So you have some things that you can have paper losses, but you also may have actual losses. And there's lots of places in the tax code that can trip you up when you have losses. One of them is if you have taxable deductions in excess of your taxable income. That's called a net operating loss. And basically, you can't carry your net operating loss back and get taxes you paid for prior years, but you can offset future taxable income with your net operating loss. You can carry it forward indefinitely. And that's true as an individual. It's true as a C corporation. The pass-through entities, it's true for them, even though they're passing it through. But on the states, they may not. They may be their own autonomous entity in the states. And when you are carrying it forward and offsetting future taxable income for IRS purposes, you can only offset 80% of the future taxable income if in any given year. So you may have $100,000 of taxable income and you may have $1 million of net operating loss. You can only use 80,000 in the year that you have 100,000 of income. You don't lose the rest of it. It carries forward to subsequent years. So that's an important thing because you may be thinking, okay, well, I have this loss and now I don't have to worry about paying any tax at all for the next however long. But that's not true because the 20% is still going to be taxable. So that's one limitation, is the net operating loss. Travis mentioned earlier about interest expense. So that's the next one. In prior years, before the Tax Cuts and Jobs Act of 2018, if a business had interest expense, basically it was fully deductible. All of the interest expense was deductible. Well, with the Tax Cuts and Jobs Act, there was a little reprieve because of COVID, but you can't necessarily deduct all of the interest expense. And that is now true again. And what that means is that your interest expense is limited to 30% of what's called your adjusted taxable income plus your business interest income. And again, all of these are calculations. They're defined in federal tax law, but you may look at your company books, whether it's cash method or accrual method, and you may say, I don't have to worry about taxes this year. I've got a loss. I'm not going to owe anything. Well, no, because if you have to add back your 50% of meals that you can't deduct, you're not allowed to deduct any entertainment expenses. You may not get all of your interest expense. So knowing and projecting what your actual taxable income is makes a big difference. Starting for 2025, the concept of the adjusted taxable income for purposes of determining the 30% of your interest expense is basically EBITDA. It's kind of the same thing. The depreciation is for tax rules, not GAAP rules, but it's very much similar to EBITDA calc. And there are some exclusions for small companies. A small business and I use the air quotes, sorry, is what's called, that you look at the average annual gross receipts for the trailing 3 years. And if you exceed 31 million, then you're not considered a small business. But one thing that trips a lot of companies up is they're not necessarily considering all of the companies they're related to. So just like you have a family with siblings and cousins and aunts and uncles and lineal up and down, when you look at businesses, if you have more than one business that you are controlling or that you have ownership of, you may be part of what's called a controlled group. And then all of these limitations that we talk about come into play based on the controlled group's average annual gross receipts. And if that is true, it then affects each separate business, even though any of the separate businesses may not meet those rules. So it's really critical to make sure that you are evaluating whether or not you are part of a controlled group and then know the tax dynamics of those other entities. The other companies that do not have to worry about the interest expense rules are an electing real estate company. And as Travis mentioned, they gave up bonus depreciation forever. And that didn't seem like a big thing when bonus was being leveled down. Now it's a big thing because now bonus depreciation is back at 100%. Travis mentioned that we're thinking that there will be transitional relief where you can opt back into allowing bonus depreciation, but until it is part of the tax code, we do not know. And then a few of the other things that apply for pass-through businesses, which would be an LLC that's taxed as a partnership or a partnership itself, an S corporation. The owners have to evaluate whether or not they materially participate in the activity. So you may have 5 owners in a business and 4 of them work in the business all the time, and the 5th one was just putting money up, let's say, or retired 7 years ago. And if the company has losses, then each individual shareholder or partner is determining whether they materially participate, and that controls whether or not they get a current year benefit from any of those losses. That's called passive loss limitations. And if you have passive losses, then you can only use passive losses against passive income. And the passive income may, or in the year, doesn't have to be from the same activity, or in a year where you have a complete disposition of that passive activity. So again, you have losses on paper, but you may not have losses on a tax return, and that may be very limiting. And then you still end up paying tax. And another one of those really insidious, and I call this one kick them when they're down, is called an excess business loss. So you've now calculated all of your losses. Everything has flowed through to the shareholder or partner. They may have a whole bunch of different businesses, and now they have to add up all of their losses and all of their that are allowed, all of their income items. And if the net is a loss, and the net loss is more than $305,000 for an individual filing single return or $610,000 for a married filing joint return, anything above that amount is now suspended and it converts to a net operating loss subject to carry forward in the future an 80% limit. So what we have found is a lot of clients know that they have, oodles of losses, even if it's because of bonus depreciation or other of the things that we talked about before, but that may not translate as a deductible item fully in a current year. And you may have interest income, dividend income, capital gain income, wages. You may still be paying tax on all of those because those exceed the 305 or 610,000 limits, and you weren't anticipating that because you knew you had losses. It's really important with tax law that is so complicated that you do a projection, that things are modeled out, that you are dealing with people who can advise you and understand all of these different kinds of limits that apply. And then on top of all of that, if you're involved in a pass-through entity, you also have limitations based on your basis. And basically that means, what are you economically at risk for because you contributed money or you lent money, and therefore you're allowed to take losses against that basis or take a distribution against that basis. And there are different rules of basis for partnerships than there are for S corps, as if everything else wasn't complicated enough. So all of those pieces come into play in federal tax law. And Taryn, how do they affect states?
How about state? It's just like federal. State, we're like
that's not enough. You really want me to go on? So yes, everything that Terry said. Now you got to think about your states, and each state's going to be a little bit different. It does get very complicated when you can be in a loss position at the federal level and still owe state taxes. For example, bonus depreciation. Florida has decoupled from bonus depreciation every time it's come around. I'm sure it'll do it again. You'll get 1/7 of the bonus depreciation and take it ratably over the next 7 years. That can flip you from having taxable loss to taxable income. From the federal level to the state level. Your apportionment comes into play as to what your net operating losses are going to look like. Do you get an NOL at the state level? It's not always the same NOL that you get at the federal level because you don't pay on the same tax base, right? We talked about apportionment earlier. I don't have to pay on my entire tax base here in Florida. I only have to pay on an apportioned part of that tax base. Well, they're not going to give you all of the NOL if you're not paying tax on that entire base. Couple states, they do, but just to keep it fairly simple, your NOL can be different in the state than it is at the federal level. There were times that you could carry back federal losses. Florida has not let you carry back an NOL in years. So we had at times a disconnect there where your NOL would be vastly different at the state level than it would be at the federal level because you could carry it forward but not backwards. There are still states where you can carry it backwards. Not many because it gets complicated and states have kind of done away with it. But you do get to carry it forward. The question is, what do you get to carry forward? Do you carry forward based on the NOL that you create in that year, and then do you apply it before apportionment or after apportionment? Do you get to use all of it if you apply it before apportionment, or do you have to apply the apportionment factor from the year in which you created the NOL? So even tracking your NOL, so just because you have losses this year at both the federal and the state level, and then let's say next year you have losses at the federal level because of a carry forward, your carry forward may not be big enough at the state level to cover the state income tax, and you end up with a state tax even though you had that carry forward. So you have to track these losses all the way through, and you have to look at each one of the states because each state's going to treat it a little bit differently. Florida's is fairly simple in comparison to some of the other states. The flow through is the other question. You know, here in Florida, we don't pay tax at the individual level, so we're not worried about the flow through, but your other states you are, right? Those NOLs flow up to the individuals, and all of the different things that Terry just walked through can be treated differently at a particular state level. Most of them will follow the passive activity loss rules. They're not going to change the materiality, but whether you're not materiality, but whether or not you're a material participant. Although I did just have an audit on an individual where we had an IRS audit. The gentleman is a lawyer. He had horses. He was doing a racing and breeding of horses, and Delaware tried to tell us that that was not a true business and that he couldn't take the losses for it. He had won the same audit at the federal level, and he was a material participant, and it was a real business. Everything went through at the federal level. Delaware still pushed, and it took us a long time to get them to the same position because they don't follow the same rules necessarily. Similar to, I'll just bring up another rule that oftentimes can be different, but the states usually roll on it: transfer pricing. If you have transfer pricing between related entities, where you're taking a deduction at the federal level, it consolidates usually. Transfer pricing at the state level, you're pulling income from one state and putting it into another. So you're reducing your state taxes and shifting them around. States will challenge transfer pricing, but if you have a transfer pricing study, you usually can hand it to the state and they say, all is good. The same thing should have happened with this IRS audit and the horse racing, but Delaware dug in its heels, and states are starting to do that. They need money, so they're not just folding just because the Internal Revenue Code and the IRS said this is okay, we agree. States aren't following those. They're saying no, we have our own rules, and so you have to start to translate which rules does the state really have. So it can be a benefit and a burden, I'll say, because we can get creative. We can help look at the losses and make sure your apportionment is proper. We're doing the right sourcing, and reduce those state taxes, even if we can't do anything at the federal level. As Terry was talking about with brothers, sisters, there's different state rules about whether or not those entities do have to be taken into consideration. In Georgia, they don't. In Texas, they do. Here in Florida, you can choose. Florida kind of, do what you want, and then we'll decide if we like what you said. Florida's notorious for, we're not going to tell you what to do, but if it doesn't work for us, then we're going to tell you.
We'll let you know.
Yeah, you're going to hear it if we don't like the way it turned out, and then we'll tell you what the rule is. So
what a fun way to plan, right?
Yeah.
Well, speaking about planning, Kyle, we're going to go to you. You've been patiently waiting there, graciously. So we've heard a lot of updates, changes, and the whole 9 yards. What are some general tax planning tips?
I would say the biggest tip is pretty simple. It's to start early. Don't wait until January. By then, a lot of your options are gone. So for manufacturers, that means reviewing capital spending plans right now so you can take advantage of 100% bonus and cost segregation opportunities that we mentioned earlier. It also means looking at your cash flow and timing income and deductions, like accelerating those equipment purchases, or even maybe deferring income if you're expecting a lower tax bracket next year. Secondly, I also recommend connect your tax planning for your business to your personal goals. If you're thinking about an exit in the next few years, you want to start the modeling now. So strategies that Travis talked about earlier with qualified small business stock exclusion or opportunity zone deferrals, which can dramatically reduce taxes, but only if you plan ahead. These are not last minute moves. They require structuring and timing well before a sale. And then finally, don't overlook state taxes. Nexus and apportionment rules are getting more aggressive, and states don't always follow federal changes, as Taryn has noted many times. A quick review at year end of where you have payroll, property, and sales can help prevent surprises and audits. So Bottom line, tax planning isn't just about compliance. It's about aligning your business decisions with your long-term goals. And the earlier you start, the more options you have to reduce your taxes. So start now.
All right. Very good advice. Thank you. Terry, we're going to turn to you a little bit on some exit planning. So, we've seen a lot of our manufacturing companies down here, whether the owners have sold or they've been acquired by private equity, a lot going on this year. But what should manufacturers and owners, executives do to get their company ready for a sale? When do they start? What should they consider? If you can maybe give some guidance and opine on that a little bit.
Yeah, absolutely. So first, I would say if you don't have the business up and running yet, think about how you're going to structure it. What are you forming it as under state law? What tax elections are you going to make? What do you think the trajectory of the company will be? Because that plays right into whether or not the qualified small business stock, which is only valid on a C corporation or an LLC that made a C corporation election, right? A lot of companies start out as a partnership, an LLC taxed as a partnership. They're going to have losses in the early years, and then maybe they can convert from being a partnership to a C corporation. And now they start the clock ticking for how many years they have to operate as a C corporation. So sometimes you have the benefit of a little bit of foresight in the planning process.
Sure.
But let's say that ship has sailed, you are already up and running as a company, and now you're thinking about it. Ideally, you start 3 to 5 years ahead, because it isn't what you want to do tomorrow. It is thinking about, okay, where are we now? Where do I think that we're going to go? How long do I want to be involved here? And who do I think would be interested in continuing the company? You have a whole plethora of potential buyers. It could be a current competitor. It could be a company that is upstream in your vertical market. It could be private equity. It could be your own, somebody from within your own family or within your own business. The employees may want to buy in. And each of them may have different reasons and therefore different ways that they would value the company and what would matter to them. So understanding and evaluating who your potential buyers are has a big impact on your planning for it. And you may have no idea who they are. And it's all right, well, let's just see what happens, right? Pixie stick, throw it up and see what happens. Well, if that's the case, it's still very important to have some idea what your company is worth, how it will be valued. Maybe you go for a valuation now. Maybe you do something that's called a quality of earnings report, which is something that in the hands of the buyer, it's how would the business look in their hands for them to determine how profitable it would be. Maybe it's identifying, what other expansions you can have, product lines, markets that you're not in. And it may include how do you, cut some expenses down so that you look better and healthier as a company. And it's also really important to watch what's going on in the general economy and also in your industry. I know that in a lot of professional service industries, they went in waves. If everybody kind of remembers what happened with doctors groups, where individual doctors had offices and then they were being bought up. And, in the dental world, now you have all these, Sage and everything else that they're all over the place instead of necessarily individual dentists, right? Well, that's an industry trend. And if that starts happening in your industry, then you may want to ride that wave and, get out while you can, while your industry is hot. Likewise, in the economy, if the economy has a downturn, well, that's going to impact your value. So you have to be watching what's going on in the industry. Some of the other things that you need to do is bring in a team of qualified advisors, your CPA, and somebody that has done this before. Not maybe your current CPA is fine for everyday stuff, but if they haven't helped guide companies through an exit successfully, they're probably not the right person for this stage and where you are as a company. You also should have an attorney. You also want to think about when the sale occurs and you're, now have oodles of wealth for the company or for the shareholders or partners. What kind of wealth planning do you want? Because you have to put certain of those strategies in place beforehand. Maybe you want to transfer the company into a trust, and that way some of the value of the company is outside of what would be your taxable estate. Those things aren't the day before a sale happens. Those things are, at least a good year, if not longer than that.
Absolutely.
And again, we recommend 3 to 5 years. Some of the other things, we've talked a lot about state and local taxes and how every state has different rules. Well, if you don't know if your company is compliant with state and local tax rules, if you don't know where you have exposure, I can guarantee you that a buyer doing due diligence is absolutely going to let you know where that is, because that is one of the biggest things that we see in deal after deal, that the seller didn't know they had this exposure, or they knew and they just weren't going to deal with it because it didn't matter to them. And now they come in and they find out that the buyer is going to what's called hold back money. They may have told you that your business is worth X amount of dollars, but because of this contingent or potential liability from the states, they're going to leave a bunch of the money in escrow, and you're not going to get it at closing because they're worried that the states may come back for some of those dollars. You also are going to want to clean up on the legal side if there's any gaps in any of your legal issues, if your intellectual property hasn't been perfected. All of those things should best be tended to before you even go to market with your company. And, likewise, you want to make sure that you clean up your balance sheet, that you clean up intercompany accounts, and that you start cleaning up your P&L and at least are able to track and quantify how much of your expenses are, I'm going to say, quasi-business, quasi-personal. Maybe in a buyer's hands, they wouldn't incur those same expenses. So that's really a general feel for how to go about the exit planning. And I see, Taryn, your hand is up.
Yeah.
Of course. Sorry, I have to, state and local. Having done M&A and due diligence, pre-due diligence, I've been on the side of the table where I lower those prices because I find the issues. There's two main issues that I just want to point out, and Terry, you alluded to them. Sales and use tax is one of the first ones we always look at, especially in a manufacturing industry, when we're either a PE coming in or you're selling the entire company. It is low-hanging fruit for somebody doing due diligence to make sure that that is in place. And if you clean it up on the front end, even if you've got to go into VDAs and you can't get them all done before you're exiting, at least you go to your buyer and say, I already know about this. Here's how much it is. And I've got somebody that's told me how much it is. We've already figured that into the purchase price. Put it aside. It's kind of like, I know my house needs a new roof. It's going to cost $50,000. Don't take it off the purchase price. I sized the selling price for that $50,000. It's the same idea. The other one is payroll. Employment taxes, not necessarily state, but I've done the federal side of employment taxes, and I think Kyle can probably jump in on this. The difference between employees and 1099s, and I know a lot of new reporting requirements on the 1099 side that I can't speak to, but I don't know, Kyle, if you want to jump in there, but that isn't the other piece of the low-hanging fruit that comes in. And you can't even get reps and warranty insurance a lot of times because of the sales and use tax and the payroll tax issues.
Sure, yeah. Misclassifying employees and independent contractors is a huge red flag when looking to sell your business.
Yep.
So something to clean up now, especially with 1099 reporting heading into this January.
Good advice there.
Yeah, and the your buyer is going to want to see good financial information. And it's okay if you don't have audited financial statements, depending on your size. It's okay to have financial records that are clean, that are healthy, that make sense to a buyer, that when they ask you questions, you can answer, or your CPA can answer the questions. And depending on how big your business is and the price point that's involved, you may need some of those. You may need a valuation. You may need a quality of earnings report on the seller side to be able to hand to the buyer. Large firms like us can certainly help you with any of those. We do that for lots of our clients. But the key is you need to know your business and know where your strengths are and where your weak points are, and be able to address both of those so a buyer coming in would potentially feel comfortable.
Good advice, Terry. We have about 15 minutes left, and we're going to shift here. We're going to close out with individual basis for taxes. So, Terry, um, maybe if you could, we were talking a little bit about exit planning, right? What do you do with all this wealth? But what should, people know about planning and getting ready to maybe give away some of their wealth and their fortunes, whether it's to the family, but not to the IRS. So.
Not to the IRS. So everybody during their life or upon passing, they have effective for this year, basically $15 million that they can give away. And that seems like a lot of money. And for a lot of people it is, but there are a lot of people that have more wealth than that. And for a married couple, if the first spouse passes, they can transfer any unused amount of that 15 million to the surviving spouse. But there are a lot of things for very wealthy families that we can do to help, including making suggestions about what assets should be gifted, how to do the gifting effectively so that there's benefit of some discounting, meaning you may have a $10 million asset, but if you can transfer it at only a $7 million valuation from IRS rules, you've got a 30% discount and you have more assets that you can continue to pass before you would have to pay an estate tax upon passing or a gift tax on any of your transfers. And everybody can gift, obviously if they want to, $19,000 per recipient. So you could have 100 of your closest family and friends, and each one of those 100 people could get $19,000 a year. So there are ways to transfer wealth and to make sure that as you are selling business and getting your proceeds, that you have set up as much of it to be outside of your estate as possible and in as preferential way as possible. And that involves estate planning in advance, not the day before you're closing on the sale of the business.
All right, very good. Not to get political on anything, but no tax on tips, no tax on Social Security. Is that true? I guess.
No and no. That's the short answers on both of them. So there is an exclusion of up to $25,000 on qualified tips. That is true. There are obviously caveats because, tax law. So we all know that caveats, right? So the tips have to have been included in your W-2, or if you're a sole proprietor on your Schedule C as income. And it's only for professions that were normally getting tips to begin with. So you can't now add new professions that don't tip your CPA. We're not allowed, your attorney, right? It's not tips like that. It's in the professions that you would normally have thought of being eligible for tips, hairdressers and drivers and, hotel staff and entertainment and hospitality staff, food and beverage, those kind of things. And if you have taxable income of more than 150,000, if you are single, or married filing joint, 300,000. If you're married filing separately, you cannot get any benefit of this. And one really interesting piece of this is the tip has to be voluntary. It can't be a service charge or a mandatory gratuity. So if you think about going to a restaurant and you've got your party of 6 and they have that little thing on the bill that says, we have a mandatory charge of 18% on parties of, more than 5, that's not considered a tip. And even if it ends up going to the server and ends up in their W-2, that's not eligible for this. So those are some of the caveats. And then the same with Social Security. It's not no tax on Social Security. It is that seniors age 65 or older before the end, as of 12/31/25, that a $6,000 deduction. And again, you have to be filing jointly if you're married, or you don't get it. And it phases out. So at 150,000 of adjusted gross income, it phases out for an individual, right? So for a married couple, 75,000 per individual. So yes, you get a deduction or you pay less tax, but really not the whole no tax on tips and no tax on Social Security.
There you go. All right. Thanks for the clarification on that. And the last question of our session, what should people be thinking about for their own personal taxes in 2025 and 2026? we'll kind of end it there.
Yeah, so thank you. I know we've covered a lot of stuff in
Great
this
stuff,
2
though.
hours. And if anybody has any questions later, we're always happy to answer questions and be a resource to SFMA and its members. I would say that the most important thing is that looking at your tax liability across years, across types of tax, across jurisdictions, so that you are minimizing across all of that. Sometimes it means you're going to pay a little bit more tax in a current year because you're in a lower bracket now and you know your income is going to be higher next year. So you want to pull income into the current year to have it taxed at a lower rate than you otherwise would have currently, or vice versa. But it's thinking about what your tax profile looks like unique to you, including everything that has happened that we've talked about, whether it's any limitations on losses, whether it's you being charitable because it was a really good year and you want to make charitable contributions so that you lower your taxes. It's understanding what tax law changes happen next year in 2026 or in 2027. It's understanding that there were changes in credits that you were allowed to take, right? If you put impact windows in your home as an example, or anything else, like there were so many changes and you can't possibly know all of them. And it's why we have people from national tax, we have state and local people, we have international tax experts at the firm also, because I can't know everything. And it's understanding that you have to be working with professionals who can guide you for what you have going on. And some of the other things is making sure that you're maximizing the pre-tax items. If there's 401k plans at your company, employee elective deferrals, if you have health savings accounts, if you have flexible savings accounts, and any of those types of things help reduce your taxable income. And, and just most importantly, it's planning for all of this. It's not wait until April 1st, sit down with all of your documents, right? And then start doing your taxes then, because a lot of the opportunities that you might have had to save money will have gone by the wayside at that point. So it's planning now, year-end projections and year-end planning now for 2025. So you understand what you can do before year end. And just to circle back to something that we started with real quick, Sasha mentioned at the very beginning that two Haas machines came in and they're now sitting in the company. And that ties into the machine being in the shop isn't enough for the depreciation. It has to be plugged into the wall and ready to go. That means it's placed in service. And even just knowing that matters, because otherwise you could have paid all the money, thought that you were going to get the deduction, and then you don't. So I think, yeah.
Yeah, and for Sasha's purchase, there shouldn't be any sales tax paid on that.
Exactly.
Capital equipment. So if anyone's paid sales tax in the last 3 years, let us know. And FPL too. If you're paying sales tax on your energy bill, let us know, because you can go back 3 years. That was a dynamic panel here. Great thought leadership, great questions, great insights. Does anybody have a question for any one of the panelists? We have a couple minutes left. Any questions? Anything? Something we didn't cover that you may have a question on? Please, if you do have a question, you can go off mute, ask the question, or if you want to type it in the chat, but the time would be yours.
And it's free.
No question. It's free. There you go. Just because you're an SFMA member. Otherwise, they'll charge. No, I'm just kidding. Any questions about anybody? All right. So, question I just got put in the chat here. Thank you, Jim. Who can I talk to about getting a proposal to do my tax work?
Jim, happy to have you reach out to me or Kyle, either one of us, and then we will loop in whoever else on our team would be applicable. If there's, nexus studies, state and local, if there's international tax issues, happy to work on a proposal for you and understand what your needs are.
And Jim, I'm going to put Terry's email in the chat for you, so you can pull it from the chat here. Give me just a second. Any other questions? Okay, here you go, Jim. Here's Terry K's email. Right at you. All right. Well, if there are no other questions, thank you, Taryn and Terry, and Kyle and Rich. I know Travis had to leave a little bit earlier. Thank you to him as well. So we will definitely send this out. So if you missed anything, we'll send this out to everybody. We'll get you the recording, and if you have any questions, let us know, and we'll go from there. Oh, Sasha, I see your last thing there. Go and miss you. Oh man, that's a dig. Oh man. Oh, I thought we were friends. No, I'm just kidding. But thank you, everybody. It was great. It was a great session today. Thanks for joining. Again, thanks to our partners at CohnReznick. Thank you for all you do, and we'll see you all soon.
Bye. Thanks,
Thanks,
Matt.
Bye-bye.
Thanks, everyone.
Thank
Great,
you.
thank you.